All right, I'd like to call the Audit Committee meeting to order. Could I have a roll call, please?
David Chanel, present.
Veronica Kell, present. And Andrea, since you're on FinCom and I see that you're here, just very quickly, do you know if Lynn is still our FinCom representative for the Audit Committee? She's muted.
I don't know. She was on the FinCom when she was appointed. She's now resigned from the FinCom, but has not resigned from that committee.
Okay. All right. Well, she isn't present, so it's just Dave and I for the Audit Committee today then. All right. So we asked Zach to come to just go over the financial statement and the management letter with us. On the agenda, I had put, these were the things that I was interested, the overall pros and cons of Townsend's financial situation, to discuss that. Any key metrics for financial health, what should we be looking for as far as going forward goes? I know this is FY20 that we're looking at here, and we're now in FY22, but it would be good to note. And then in the management letter, the GSABs, just some idea of where we are with those, what that means and where we are. So with that, Zach, I think I'm going to turn it over to you.
Perfect. And before we get started, I know, is there anything, David, that you want us to focus on? And I guess I just wanted to kick that question out. As we anticipate that this will be very conversation-based. As questions arise, please feel free to just interject, and we're more than happy to clarify, answer any additional questions. But before we got going, David, yeah, I just wanted to kick that to you and see if there's anything.
And I appreciate it. I'm here for the ride so far. We just kind of conveyed this audit committee. So I'm a past selectman, as is Andrea, but I'm just listening and watching for now.
Absolutely. Yes.
And I just also want to say that the audit committee, this is the first time the audit committee has been seated. And so the policy states that we are to solicit, interview, and recommend to the Board of Selectmen the firm of independent auditors that is to audit and report on the financial statements issued by the town. And we know that we have one more year with Melanson and Heath as far as the contract that was in place goes. So one of our charges is to look at that going forward for the following 3 years. And then we also are to transmit a copy of the completed annual audit financials and management letter report to the Board of the Selectmen and the Finance Committee, and with the assistance from the auditing firm, if so desired, present the results of the annual audited financials and management letter report to a jointly held public meeting of the Board of Selectmen and the Finance Committee. So although we were not involved with, it says that, again, backing up a little, we are to review the audit plan with the independent auditors, meet with the independent auditors to discuss the results, the management letter, and the financial reports. So that's kind of what this is, but we're late in the process because we really didn't start meeting until April, May this past year. So hopefully next year going forward, we'll meet with you a little sooner and be better prepared to do this. So that's all I have to say.
Perfect. And, you know, I guess before we get started, I think I would like to introduce Ed Boyd. Ed Boyd is the engagement principal. He's been the principal on the Town of Townsend engagement for a number of years. So naturally wanted to bring him into this as he is the overseer of all things Townsend.
Well, thank you, Zach, and happy to be here. And as Zach said, we'll happy to go over the financial statements. There are 53 pages in front of you, but the unfortunate reality is there's probably only a handful of them that are really key or significant, and that's really what we want to drive home today is help educate you folks, and we're happy to take any questions because we really want this document to kind of stand on its own. And you as the audit committee, as you're really kind of just getting going and kind of taking your charge here, the more that we can educate you folks in understanding how to read these financial statements, what do they mean, what do we need to look for year over year, I think that's only going to help the process. So with that said, I'll probably kick it back over to Zach, or I'm happy to go here. But as we go through this, please, as Zach said, we want to make sure that things are understood, things are clear. And so if you come across something where, that we need a little bit more clarity, please stop us in our tracks, and we're happy to kind of take a step back and go over things a little bit further here. But that's, I think we're all in lockstep here as far as what the objectives are. And, I think in an hour's time or whatever it may take, I think we'll all have a better understanding as to where the town is as of June 30, 2020, and what to look for moving forward.
So to get started, as I alluded to, this is a 50-some-odd page document, but there are key pages and key things that we have to look at to use that are valuable in these financial statements. Now, the first page that I'll push us to is page 2 of the report. And you'll see about halfway down the page, or a third of the way down the page, the title and the header, opinions. What you'll see in here is that the town's financial statements for FY 2020. Yes, David.
I don't have a copy of that document you're referencing.
You do not have a copy of the financial statements. Okay.
I don't have it. I was going to just go by memory, but it's been too long.
Okay. Let me see.
I can tell you where to find it on the town's web page.
Okay, that might be better.
So
All right,
if you go to the Town of Townsend and you go to Board of Selectmen, on the left-hand sidebar, it says financial statements. Audited financials or some such thing.
Yeah, you're giving me way too much credit, Veronica, for typing faster than that. Where is Board of Selectmen? Why don't you continue, and I'll catch up.
Okay. Oh, you do? Oh. I have no idea. They've just always been posted there, so. Yeah. Zach, do you know, do we need your permission to post these on our website?
They've typically been posted, I believe, and we generally do not have issue with that. It's a public document.
Yeah,
so.
there is no restricted use on this particular file. So.
Okay.
All
right, they always have been. I had no idea.
Okay, and is this the one that's year ending June 30th, 2020?
That's correct.
I'm all over it. Go for it.
All right. So we are on report page 2, not PDF page 2. And we're going to look at the opinions header there. And underneath that, that indicates that in our opinion, which is the key of the audit, is in our opinion, the financial statements are free from material misstatement. And what that is, that's considered a clean audit opinion. That means that we believe that the numbers that are presented are materially fairly stated in all of their respects by each opinion unit. And when thinking about an opinion unit, that's generally columns. So in these financial statements, we don't give just one opinion, we give multiple opinions on various elements that are presented in these financial statements. So that is one of the key pages, and one of the first things you're always going to want to look at when you receive these financial statements is, let's make sure we have a clean audit opinion. If not, that means these books and records might have some bigger questions surrounding them. So hopefully we're all on the same page there. Ed, if you want to add.
Just to kind of reiterate, anything other than a clean opinion is really going to start having your key users. And when I say key users, that's typically going to be the credit rating agencies, and that's going to be your bondholders. Anything other than a clean or unmodified opinion is typically going to generate some questions. But as far as I've been in the town of Townsend, I don't believe there's been any modification of an opinion that we have given.
So that's a high thumb, very high thumb, good thing.
Okay.
Now, the next few pages, we can look at page 3 through page, let's see what we have here. Page 10, and what that is that is the management's discussion and analysis. And what that does is try to summarize some of the higher level items that happened and why they happened in the financial statements. So you can understand a lot about what happened at the various bases of accounting, being the accrual basis of accounting and the government-wide financial statements, or the modified accrual basis accounting and the fund financial statements. That's where this is kind of talked about, and just brings to highlight a few of the major pieces of the puzzle for the town's fiscal year 2020 activities. So what we'll see, and what I want to focus on a few things here, we can certainly come back to certain pages in here, but one page that we may want to start is report page 7 under the governmental funds. And what this talks about is the general fund, and the general fund's unassigned fund balance as well as its total fund balance. Now, this is an incredibly crucial component to the users of the financial statements, because what the unassigned fund balance of the general fund represents is largely the amount of monies that are available for future appropriation for the town to continue to fund its general operations. And one of the metrics and one of the numbers that is presented in the MD&A, and the reason why it's presented in the MD&A is because it's looked at so crucially by users of the financial statements, is that column on the rightmost first table where it says percentage of general fund expenditures. And what that's looking at is the fund balance as a percentage of the total general fund expenditures. And what we'll see is that in fiscal year 2020 at the year end, the total unassigned fund balance of $1.7 million in comparison to the total general fund expenditures represented about 7.52%. Further, the total fund balance of 2.769 represented about 12%. And for a trending metric here, if we focus on the unassigned fund balance of the general fund at $1.75 million and 7.5%, in FY19, that was 2.049 million, or 8.99% of general fund expenditures. And in FY18, it was 2.61 million, or 12.32% of general fund expenditures. So in 18, 2.6, 19, 2.0, 20, we have 1.7. As we can see, that number is going in the downward direction. And that is one of the key pieces that is looked at by users, by bondholders and rating agencies, users of the financial statements, in understanding what is the fiscal health of the general fund. Now, the reason, or one of the reasons why this number has went down over the last few years, is because the town has used a lot of free cash to fund its budgetary and capital commitments as part of the budgetary process, to the tune of $672,000 in FY20, $805,000 in FY19, and $763,000 in FY18. So the use of free cash to fund these capital projects and these operations does draw down some of your historic unassigned fund balance for free cash. Is everybody with me so far?
Yes.
Okay, Ed, do you want to add here?
Just one thing I do want to clarify or point out, just as you're looking at the quote unquote general fund in the financial statements, this also includes your stabilization funds or stabilization accounts. Just want to make that very clear, because for financial reporting purposes, not to get overly technical, but GASB 54 came out probably in and around 2012. Your stabilization funds, you should be over in special revenue funds, but because those are really just reserve accounts or savings accounts, it was really better presented as part of the general fund. So it's just one thing I like to bring up, because sometimes what folks in your position will do is, how do we reconcile the general fund back to what's in the general ledger? And sometimes you're going to have some of these reconciling items, because we have to take that data and roll it up and put it in the proper columns that Zach had mentioned. Now, just to add a little bit more perspective here too, and to what Zach was saying, there is a downward trend in the general fund. Now, the 7.5% of your general fund expenditures, or call it your general fund budget just for discussion's sake, isn't all that bad by itself, okay? But again, that's going to depend on what what the community is looking for as far as, you know, bond rating goes. And you're looking at it in reality as far as, is this by design? Do we have a plan? Did we expect to be here knowing that, you know, maybe moving forward in the next year or two, we do have plans to build that up. So anytime you're talking about unassigned fund balance, I think understanding the why is very important, and then forecasting ahead, you know, where you see it being. Now, you've wanted some pros and cons and some metrics. Just to maybe give you some numbers, when we look at some of the, certainly the AAA rated communities or some of the higher rated communities, you're typically looking at a benchmark that's over 10%. Now, to further that, and you might say, you know, where does that number come from? One of the things I do have in front of me is a recommendation from the GFOA, or the Government Finance Officers Association, and they do recommend that a government typically, or best practice would be to have about 2 months worth of operating expenditures, or what is in the ballpark of 16%. Now, we understand that each community is different, but they've come out and said that regardless of size, regardless of operations, that's kind of the number that they wanted to hang their hat on, because I believe through case study, that was a number that they felt was at a level in which you weren't going to have to raise taxes, you weren't going to have to cut services. It was kind of a sweet spot, if you will. That doesn't mean that every community is going to be in that ballpark, but what Zach and I were talking about earlier, you know, it might be in the town's best interest to potentially think about a fund balance policy and what might be a target range for you folks to fall in, because, you know, we understand that, you know, in some cases it might be policy where the community wants to give back to the citizenry, and they might be comfortable with maybe a little bit less of a reserve balance than the 2 months or even 10%. But I think it's worth conversation to understand, where do you folks want to be? And again, it doesn't necessarily mean that you have to stick to it every single year, because things will happen, but some type of policy initiative in which you could have a target range of where you folks want to be.
And to add to Ed's level there, and that's, you know, the 16%, again, that's a decision that the town has to make. Where do we want to be? The number that the town was at when it got its last rating from Moody's, which the Moody's rating is continued and has been AA3 since fiscal year 2018. And at fiscal year 2018, that number was 2.619 million of that unassigned fund balance, which represented the 12.32%. So at the town's last issuance of general obligation long-term debt, public offered, was 12.3%. That number has now went down to 7.5%. So if the town went out for rating, that would be something that would be discussed during the ratings call, we presume. Now, naturally, we don't know what Moody's is thinking every day. They change, but that is something in the unassigned fund balance as a percentage has been readily focused on by ratings agencies at any call that we've been a part of.
So,
Yes.
so they look at the numbers, just the specific flat end percentage. They don't look at the reason for the downtrend. Let's say if we had a one-time capital expenditure for a new fire truck for 300,000, whatever. They don't look at the cause or the reason for the expenditure. They just look at the result of the percentage to the budget.
Of course not. It's a combination of both. So on a base level, they understand why things need to happen. And let's say you have that $300,000 expenditure for the fire department, but we're continuously regenerating turnbacks on your revenue and expenditures for budgetary purposes. That would be looked at and certainly incorporated into the calculation. So it's a little bit of a blend that they will look at it and say, well, what are you using it for? And if you're continuously regenerating new and improving or increasing unassigned fund balance, that's what the focus is going to be at.
Okay, so if you were using it to balance off your budget with non-reoccurring funds, that looks more detrimental to the overall numbers, right? I would think.
Yes.
Okay.
It's very different when the town's saying, yeah, we need to balance the budget versus we want to put $500,000 in a stabilization, a capital stabilization.
Sure.
account. Where on the surface of it, let's say all things being equal, revenues came in where they should be, expenditures came in where they should be, but you have this movement of $500,000. That's going to look like your unassigned fund balance went down, but in reality, you've done something that's pretty positive and proactive, and you're using it for a non-operations line item, which again, you can either explain that in the MD&A or during the call. In particular, they'll likely ask you, and those are some of the things that you can bring up. Again, it was planned, add perspective, add context, understand that this isn't necessarily a credit weakness, but actually a credit strength.
Okay, thank you.
And to break down kind of some of what happened in this, or in the total fund balance change, there is a table right underneath on page 7 that kind of talks about what happened during fiscal year 20 to lead to these results. Now, this, as Ed was saying, you can either talk about it in the ratings call. This doesn't translate necessarily one-to-one to the exact number of what happened in the change in unassigned fund balance. But what you will see is that 584,693 decrease does talk to the change in the total fund balance. And here we simply outline a few things of what happened. Revenues came in less than budgeted last year to the tune of $338,000. But on top of that, expenditures came in less than budgeted to $297,000. And we can see the large driver behind this is the use of free cash, an overlay surplus for budgetary purposes of that $692,000 in fiscal year 2020. So that's largely where you can see some of these activities taking place. And it does break down a bit why. That's really what the MD&A is trying to do and assess, is help the users of the financial statements understand the why of what happened this year. So hopefully this helps give a little perspective in the MD&A. And Ed, if you want to talk about, we can go to the statement of net position or the governmental fund financials, whichever you prefer.
Before you move on, Zach, just a quick
Yes.
question, and everybody may know this, but what is overlay surplus?
Overlay surplus is when, I guess to put it in a broad sense, when on the recap, the town, every community is required to raise what's called overlay or an allowance for abatements. And essentially what this is, it represents an amount that's estimated of what property taxes are going to be abated either during the fiscal year or potentially even subsequent years. Now, in some cases, you might have collections that are to the good, and just, I guess, just to throw some numbers out there, let's say you expected to abate $250,000, but your abatements came in at $100,000. So the way that, not to get overly technical, so our apologies here, but on the modified accrual basis, what happens is you have what's called deferred revenue and an allowance for abatements, and so you're not able to recognize that revenue. That would be similar to an accrual basis or like a commercial or private company. So it's kind of sitting as a liability. But then what happens is the assessors, what they'll do in conjunction with Terry, and what Lori did, is when you realize that you have enough, you essentially, you don't have any receivables or potential abatements coming, you can release that overlay into fund balance, which becomes essentially a funding source to utilize.
All right, so it's
Okay,
funds
Terry?
that you hold for abatement purposes.
And you've raised it on the recap, meaning you've budgeted for it.
Okay,
It's like, oh, you won't see it in the budget, but it's something that happens on the recap.
And the reason why you don't see it on the budget is because that property tax revenue budget is net of that amount. Because you're essentially saying from the get-go, we're going to build this, but we're likely to abate this. So in an effort to have a better picture as to what you're expected to collect, that number is looked at net. So you're really going to have a hard time kind of seeing what you abated outside of maybe talking with the assessors or the accountant.
Okay, thank you.
Now, maybe before I jump in here, I know we've thrown a lot of numbers at you. We've thrown a lot of percentages at you. Are we comfortable with really kind of what unassigned fund balance is, what has happened over the last couple of years? And again, I still think it will probably come up in the next couple of minutes, but just before I moved on here, just wanted to pause for a moment.
I'm
I'm good.
So the next two statements that we're going to get into here, and I say two just because I think it's important to understand the difference. So David, this is going to be report page 11 and report page 13.
Thank you.
So we'll start over at page 13, and Zach started getting into this a little bit earlier. This is your governmental funds balance sheet. And back on 11, that's your statement of net position. And what you're going to see is these statements, while they have different names, look very similar. They're both balance sheets, really. Okay. But the difference being over on page 13, this is what's called the modified accrual basis of accounting, or really, for discussion's sake, it's really a cash basis financial statement. And you'll see here that this is much more current focused compared to the statement of net position. Now, I like to say this just to make it very clear. This doesn't mean that the town has two sets of books. This is just perspective differences for local governments. It's the same way across the Commonwealth. It's the same way across the country, and it's designed this way because I remember reading an article years ago that the point is to really provide users of the financial statements a little bit more better, and sometimes I would call it conservative information to make certain, we'll call it budgetary decisions. So what you have here, we talked about property taxes just a little bit ago in the allowance. You'll see that you'll have your receivable, but what's different than, again, a private company, when you bill, you typically debit your receivable and you bring on the revenue. What happens in governmental accounting, this is probably going to be a weird term for some of you folks, but if you go to page 13 and you go to that first column, the general fund, about 3/4 of the way down, you're going to see unavailable revenues. This is a big perspective difference for local governments, because essentially what it's saying, you can't take your receivables to revenue until they're recognizable and measurable, largely until when they're collected. Okay. But over on the statement of net position, this is a much more long-term basis. This is going to be a similar set of financial statements to, let's say Apple. And what you can see is the primary difference here is recognizing your long-term assets and your long-term liabilities. Biggest differences here being you got capital assets, you have your long-term debt, you have your net pension liability. So you can see that there's very big differences in the financial statements, because I think it's really important to note that the long-term liabilities particularly need to be managed as such. It's not something that needs to be really dealt with in a year, satisfied within a year. But again, to paint a true picture of the town's fiscal health, certainly something that needs to be in a set of financial statements. Years ago, they go back to 2013 or 2014, what's gotten a lot of attention is if we go back to the statement of net position, and similarly, it's going to be about 3/4 of the way down, you're going to see net pension liability. This was a number that for years was always just disclosed in the back of the financial statements. So you can imagine that a handful of years ago, when communities had to bring on their unfunded net pension liability, and in many cases, not to the Townsend doesn't have this, but your net OPEB liability or your total OPEB liability. So the statement of net position, while it used to really just be glossed over, now has gotten a lot of attention because communities and the citizenry are realizing that these fairly significant long-term liabilities are out there and they exist, and they continue to put significant pressure on a community year over year, particularly as we've gotten closer to 2040. and that we're still a ways away, but in trying to have these pension systems funded at 100%, you know, these pension appropriations have been going up, and again, with the constraints that are put on a lot of Massachusetts communities with Prop 2.5, when your pension assessment is going up 4 or 5% a year, and you're really restricted with how you can raise revenue, there does come to be a point in time where you know, communities might be faced with making some decisions as far as how they're going to meet those obligations. And again, with the ability to not raise revenue, sometimes something's got to give. So why I bring that up is I think it just goes back to speaking to the fund balance policy, and you know, trying to have a range that will allow for continuity of services and not really push the need to raise rates, things of that nature. But as I mentioned earlier, one of the good things with Townsend, and there is no net OPEB liability. So in many other communities, you're looking at a number that is potentially staggering. And maybe just to put it in perspective, when I say OPEB, that means other post-employment benefits, which is retiree healthcare. Now, your net pension liability is to the tune of $8.6 million, and that represents the town's portion of the Middlesex County retirement system unfunded pension liability. That's about 50% funded. Now, the good thing when we talk about pensions, I mentioned a few moments ago, the funding schedule and trying to have the retirement system essentially 100% funded by 2040. I believe Middlesex County, as of June 30, 2020, was 50% funded, and the funding schedule went out to about 2035. We actually, I believe, just got the updated GASB 6768 report, so I'm not entirely sure where that is as of the moment. But while it is a ways away, there is a plan in place to hopefully deal with some of these long-term liabilities. I'm going to pause there.
Funding of that pension liability, isn't that done by Middlesex Retirement as part of what they charge employees every paycheck?
I'm sorry, we missed the front end of that.
The pension liability, isn't that accounted for in the extra charge to employees each pay period when they pay towards pension?
Are you alluding to the 2%? Is that perhaps what you're alluding to?
I thought there was an extra percentage taken out of paychecks.
So for pensions, generally in the Commonwealth of Massachusetts, the rates have changed for this, but Chapter 32 of MGL does govern the pension withholdings and what is withheld from each employee's paycheck. Now, since 2012, anybody who entered into a pension system, they are required to contribute 9% of their salary and then another 2% on any earnings over 30,000%. So it's 9 blended up to 11, if you would. Now, that's simply just the employee portion of that's their contribution, which largely helps contribute to their annuity upon retirement. However, there is a larger liability associated with that individual, and that is allocated to each member unit of Middlesex County and payable by the employer, so the town of Townsend, via the employer contribution to the pension system. And that employer contribution is actuarially determined to essentially meet the funding schedule that Ed was alluding to, that the actuaries and everyone has gotten agreed upon on, that will go to have the plan fully funded by 2040.
Okay, and is Townsend paying what that actuarial amount should be?
So if you go back,
Yes.
excuse me. Yes, sorry. To answer very quickly, yes, but I wanted to demonstrate where we can see that in the financial statement.
Okay, so we're
Towards the end.
If you go to page 53 in the financial statements, you can see every year from June 30, 2015 up until June 30, 2020, what Townsend's contribution to the unfunded pension liability was. And that number was $854,966 in fiscal year 2020. And that is, again, actuarially determined. And you can see in column 3, you have the determined contribution, and then the actual contribution that was made by the town, which will be in column 4 on that page.
Okay, so Townsend's paying as we go, and we're basically paying according to what we're supposed to.
That's correct.
Okay,
And just to maybe reiterate too, anyone that's in Middlesex County is in the same boat.
Mhm.
It's not a Townsend is this and a Drake it might be that. But then as you can see, the town is paying what it's required to. But what Zach was saying earlier, what is kind of built into that is what's called an amortization of the prior unfunded liability. So what's kind of happening is you're playing catch up now, because many years ago, maybe the actuarial determined contribution, some of the assumptions that were in the valuation, when looked at as to, actual versus assumed, some of those benchmarks weren't being hit. Like, one of the big things that comes up now is folks are living longer. So when you go into what was previously built into some of the actual assumptions, it wasn't assumed that this individual might be getting paid their retiree benefit for 35 plus years. It could have been in the ballpark of 22, 25. And I'm just throwing those numbers out there, but just to kind of give you a sense as to why some of this may have happened. One of the things that we're seeing happen across certainly the Commonwealth, but also in other states, is the investment rate of return has gotten quite a bit more scrutiny, particularly as it goes back to the financial crisis. And I know back in around 2010, PERAC certainly was advising communities that have their own retirement systems or the county retirement systems to potentially lower that discount rate. So for years, you may have been assuming an investment rate of return at around 8.5%. Now that number in most valuations is anywhere between 7% and 7.25. So that's where some of the clawing back, if you will, making up for some things that happened in the past, to hopefully move forward and have the system funded certainly by 2040.
And that discount rate being used that Ed's alluding to for Middlesex currently is 7.3%. That was used in the 2019 or the fiscal year 2020 liability, which was measured as of the plans or the retirement systems year end, which is as of calendar year end, so 2019.
Do these numbers, are they inclusive or exclusive of the school portion?
Exclusive.
Excluded, okay.
They're exclusive on the liability side. That is something that you are paying for in terms of the assessment that you're paying to the schools annually. So
that's built into the school assessment portion?
Correct.
Okay.
Any further questions on the pension liability? And we are more than happy to talk about that. These are also, if we looked and turn to page, let's see, my apologies here, page 43 of the financial statements, you will see a number of disclosures about the contributory retirement system and the net pension liability. This is where we talk about kind of what the plan is, or the town talks about what their actuarial determined contribution was, some of the deferred outflows and deferred inflows of resources, which will impact the annual assessment moving forward, as well as some of the assumptions that are being used. So where Ed was talking previously about the mortality and how long people live, there are different actuarial mortality tables that can be updated. Currently, they're using 2014 mortality tables, which appear pretty much in line with what we're seeing across the board for other actuaries throughout the Commonwealth. And on top of that, that discount rate, among various other elements. So that is where some of the notes to the financial statements can be utilized to gain a little more pulse as to what's going on from a liability standpoint. And this is something that, as we can see, has a rather large impact on that bottom line net position number that is presented on the statement of net position.
Does the town have any option in paying that retirement amount? Could they pay less than the actuarial amount?
Could you? I think potentially.
I'm not saying we would. I just want to know if that is a mandated amount and we pay it every year, then there's not much to be said about it from a budget perspective. We have to fund it.
I would agree with that, and I feel like other communities, I think, share that same sentiment, that it kind of, particularly when you're in a county system, certainly some of the local governments that have their own contributory retirement system, where it's just the town and maybe their housing authority, they have a little bit more flexibility with how it's managed, how they want to fund it, if they want to be a little bit more aggressive, if they want to be a little bit more conservative, because I know we have a number of communities that they'll say to their actuaries, here, let's run me a couple of funding schedules using different data. But when you're in a county system, you don't have as much flexibility with making some of those determinations. However, I think where we've kind of advised some of our clients to move forward with is one, just familiarizing themselves with this data. There is good information, like Zach said. If you ever find yourself looking for something to do on a Friday night, there's plenty of light reading in the notes to the financial statements. But having I think Zach, the word that he used was pulse. Understanding who the representation is on the Middlesex County Retirement Board, and familiarizing yourself with some of the decisions that they're making, why they're doing what they're doing, and how that is going to impact the town, both from a short-term perspective, which I guess I'll say is cash flow and budgetary constraints, but also understanding how they're managing that long-term liability. Do assumptions seem reasonable? Are they consistent with other retirement systems? But the unfortunate reality is the town is a little bit, I want to say hamstrung, but you don't have as much flexibility to.
When is this deficit forecast to be paid off? Did you say 2035?
As of fiscal year 2020, the latest information that was available, yes, it was as of 2025. I'm sorry, 2035, my apologies.
So in 14 years, the town has $850,000 that's freed up?
In a perfect world, if all things were equal and every assumption hit perfectly with what the actuarials assumed, the answer would be yes to that question.
Okay, well, that's important for long-term planning.
It certainly is. And one thing that we have seen is some of these actuaries have actually extended some of these timelines. So that's where understanding what the pulse is crucial. So in 2035, I don't know if that is actually going to be perfect. The actuary may have extended or may extend in the future. And that's where having a discussion and being in tune with what decisions the retirement system board are making are crucial to understanding what your near-term and long-term commitments are going to be.
Okay, thank you.
Of course.
Pension and OPEB tends to dominate the conversation very frequently here.
Well, Townsend is somewhat fortunate not to have OPEB.
Right.
Somewhat, because I think it enters into personnel policies, but that's a subject for another day.
Right.
That's been an ongoing discussion for years.
Right. It's certainly a tough one to have. It certainly makes the financial statements look better comparably to other communities. David, looked like you were going to say something.
Well, I was just thinking, I mean, years ago when I was on the board, the pension, it didn't seem like it was that much. When did they make this assessment? Do you remember how long ago?
So the first year that it actually had to be recognized in the financial statements was June 30, 2015.
Okay, that was after my time. I know we're experiencing this in private industry as well. Affiliated with some fairly large companies that are unionized, and they're just being hit with this assessment as well. That's why some of them are going out of business because of this. So I wasn't aware that it hit the municipal industry as well.
It had been talked about for years, and again, it was always kind of known. So the good thing is when this came out, we freeze.
No, that's just, I sit still a lot, most of my day.
I guess I'll call it the good element of this is that your key users, the bond holders and the credit rating agencies, they knew that this existed. It was always just disclosed, again, kind of on the last page of the financial statements. So when this was adopted and applicable to FY15 and forward, there wasn't as much sticker shock as you might think. The numbers certainly look different. But again, I say this number, or really these numbers for all communities, it was very well known and part of their calculation. So there wasn't a significant ripple effect, but as we're 6 or 7 years into this, I think it's really kind of what is near and dear to this conversation right now is forecasting and being proactive and looking ahead is, how are communities to the extent that they can, how are you managing some of these long-term liabilities? What are the plans? And I think they can see that because we talk about in the town talks about in the financial statements. You can see if you were to look at the last couple of years, the assumptions are changing, and so things are being dealt with to try to really understand what is the liability and what do these communities need to do to hopefully down the road have that net pension liability number be zero.
Okay. And this is just our prorated share of the Middlesex community as a whole, right? So if one town goes down, it just increases the burden on the other communities, right?
That would impact a proportionate share, yes.
Yeah.
Yep.
Wow. Okay, thank you.
Any other questions on pension?
No.
Perfect. Now, I guess we'll just pop back over to page 13, and that's your governmental fund balance sheet. And, to what I was saying earlier, it really is your statement in that position minus these long-term assets, your long-term liabilities. But this is pretty much, after the opinion, this is going to be the first place that any informed user is going to go to. And well, probably in conjunction to that table that Zach had brought up earlier to get a better sense as to change in your total fund balance and your unassigned fund balance. But they're going to look at that general fund column. And again, just to reiterate, that does include the town stabilization accounts. But they're likely to go pretty much that third number up from the bottom, that $1.7 million, that's your unassigned fund balance. How did that change? They're probably going to look at some of the other fund balance classifications here too, because you see that there are 5 categories. There's non-spendable, restricted, committed, assigned, and unassigned. And really what the difference is between those categories are the constraints that are put on those dollars. So when we look at some of your restricted funds, and as we go forward, to the right, you'll see that there's a lot more that is in committed, and there's a lot more that's in non-spendable and restricted. That's because you're dealing with mainly your special revenue funds that, again, there are specific special purpose accounts that need to be spent on particular activities. So in an effort to really understand what Zach was saying, the unassigned fund balance, and what can be utilized for further appropriation, you need to recognize those constraints on those dollars because they're not available for just really whatever the town wants. So as you go down, non-spendable is what can't be spent. Restricted means that it's restricted for certain things. Committed, that deals with a internal restriction. So something that is restricted through town meeting. So when you're voting to utilize free cash for specific purposes. This also is your capital stabilization fund. Then moving down to assign, as we go down the ladder here, you can see that the restrictions or the constraints lessen. And just for what it's worth, the assigned fund balance, that represents your encumbrances, which is typically purchase orders and contracts that you're going to honor in the subsequent year. And then down to your unassigned fund balance, which is, largely available for appropriation. But typically those are really going to be the numbers that the users are going to look at is, what was, how are we doing as a total compared to the prior year? What are the different leveling up constraints placed on these dollars? And really, how much of your unassigned fund balance is of the budget does the community have? As again, that is a traditional benchmark that's looked at for all communities. Now we can move further over to page 15, which is your statement of revenues, expenditures, and changes in fund balance. To what this speaks to what Zach was mentioning earlier. The general fund did have a loss of $584,000. Again, I think perspective is also needed here because if you remember, we talked about the use of free cash and the use of overlay surplus as a funding source. So what that means is the town actually planned on drawing down that $690,000. But when you look at it from a financial statement perspective, the good thing is here that number is a little bit less than what you planned. So you essentially were able to have a little bit of positive results, but because you planned to draw from your reserves, this number was forecasted and will largely be negative. And again, so this is a combination of utilizing free cash. It did have some favorable turnbacks, but you do have to remember that this was a COVID year. And so collections were a little bit down from where they would expect it, which is largely contributing to that negative $584,000 number. Any questions on that? But that just as we probably pass it over to Zach here, but as we, again, I think it's just hopefully this is helpful in understanding the numbers, how they relate to some of the budgetary statements that you folks have seen, and really kind of painting a picture as to the why. And again, it really goes back to what we've seen over the last couple of years is that the reserves where your free cash have been drawn down, which is leading to that decrease in your unassigned fund balance. Anything on that?
No, I mean, I think you're spot on, and that gets back to one of the largest recommendations and most crucial recommendations that I think is going to come of this meeting is really establishing and adhering to some fund balance policies and procedures. And in order to do that, you have to get a pulse and understand what the town truly wants to do from a fiscal standpoint. Does the town like to borrow? Does the town not want to borrow? Do you forecast that there are going to be any long-term capital improvements that are required that are going to unfortunately have to be borrowed for long-term? And then what do we want to do with our rates there? Are we putting our bond rating up here and our fund balance down here? How do we want it? And that's a decision that the town has to make for itself. And we firmly believe in establishing these policies, at least begin to dictate that conversation a little bit. So I think that would be one of our biggest recommendations here. We spoke about a few key metrics, some of the pros and cons. Hopefully we've answered some of those questions in terms of looking at fund balance and really just paying attention to that. But again, I wouldn't call the town's use of fund balance for the budget a pro or a con. It simply depends on what the town wants to do and how they want to operate the general fund. And that's ultimately the biggest piece of the puzzle that I think needs to be filled in by establishing those fund balance policies.
And actually, that's a good point. And then to that end, we do have some communities who by their fund balance policy, or what they call their free cash policy, they make it a point to try to give as much back to the community. That's their initiative because the individual and really the administration at the time didn't really see a need to try to pump up the fund balance to get to these GFOA levels, because the town wasn't really borrowing. So the bond rating wasn't as important to the individual and the administration, because they were able to take their free cash and really just pay cash for it. And they kept their debt burden at a very manageable level. And they really didn't see the need to again, just kind of tuck money aside. So again, it's really policy. Now, I think we're probably on the more conservative side in saying that you probably should have, some reserves, but that's up to the community. It really is. But again, having, I know as auditors, we can say, you've got to have a policy for this, and you've got to have a policy for that, but I think it just helps from continuity, and it's something that's tangible, and something that can be evaluated year over year, but everybody knows about it. And it's something that you can measure the community against year over year.
Does Hudson have a financial policy document?
Funds balance policy. No.
No.
Do you have any communities that do have fund balance policies,
Of course.
such as, off the top of your head?
I do not. Lexington, Concord,
Of course.
Dartmouth, Millbury. Yeah, there's a number of communities that have them. Again, and we're talking about a number of different communities too. And one thing that I can't express more, if that policy is created, that doesn't mean it's a set it and forget it document. The needs of the community do change, and that has to be assessed on a regular basis. For example, if something happens at the water plant and there needs to be a large borrowing or something along those nature, or among that nature, that has to be established and understood. What is going on? What are the needs? Is there a large capital project? Does the town hall need to be redone? What is going on here? And reassessed on an ongoing basis.
Okay.
So that largely is going to cover some of the metrics from a financial statement standpoint. Keeping it high level again, we can get into the weeds, but given that it's 3 o'clock, I just want to touch very quickly. I know everyone's time is important, on some of the recommendations in the prior management letter, as I know that was on our agenda today. If allowed, I know it is 3 o'clock. I don't know if we have some hard time constraints on this.
Honestly, we can, I don't know about you, David, we can take a few more minutes.
We can't hear Veronica.
What'd you say?
We could not hear Veronica.
Yeah, do you have time, Dave, or
I
are you?
have a few more moments if they want to go through the top, just the brush the surface
The
of the
4
recommendations.
recommendations?
Yeah.
Okay, yeah, let's go through the 4 recommendations in the management letter.
Perfect. So the first recommendation has been a recommendation of ours for a few years. Unfortunately, the town during fiscal year 2020, as well as fiscal year 2019, had experienced some turnover, and this really became an issue going back, I want to say, into fiscal year 2017. So we've been making this recommendation for a few years. Terry, you've been there. You know that there's been some turnover. There's been some moving parts. But what we're looking at here is just to continue for the town to continue their improvements over monthly reconciliations. There were some improvement made in fiscal year 2020, which was fantastic. But essentially what we're looking at here is there's a variance that exists between the collector's office and what they maintain as a balance in a specific account and what the town accountant maintains as a balance in a specific account. Those should be reconciled, and we really just want the town to dedicate some resources to be able to understand what that variance is, and then do as they wish to hopefully identify which bucket is correct, if you would. The second recommendation is to improve the timeliness of cash receipt postings. This has also been a recommendation for a number of years, and essentially our recommendation on that side is for the town to be able to reconcile and post timely cash receipts. So the money that's being brought into the treasurer side of things and posting to the general ledger, that way the data that is being utilized to make decisions in terms of a revenue forecasting for budgetary purposes, as well as for any reconciliation purposes, we understand what's come in and what where we are from a budgetary perspective, and even some of our grant funds. When you have grant funds and the receipts aren't being posted timely, you don't know where you stand on that line, and that's where it's crucial to have the timely posting of cash receipts so that the individuals who are making decisions have the most accurate and up-to-date data to be able to make those decisions properly. So those are our two higher recommendations that we have made for the last few years. We would like to continue to see those helped. Fiscal year 2021, I have a feeling we're going to have those same recommendations. Just given where we are and given the turnover that was in a few departments, if I was a betting man, I'd say, why don't we bet on seeing these and revisiting them again at the end of fiscal year 21. But the informational recommendations are to prepare for the implementation of GASB Statement 84 and for GASB Statement number 87. GASB Statement number 84 is related to fiduciary activities, and it really eliminates the use of what have commonly been called agency funds, and they establish custodial funds versus how things need to be put in and reported in other funds. Talking about like performance bonds, which were historically in agency funds. What it's trying to do is essentially establish a measurement focus for these fiduciary activities and to liken them more to other activities that are similar in nature to financial reporting elements that are already in existence. So that's Statement 84. Terry, we talked about some of the revenue and expenditure accounts that do need to be created, and we're going to look at that and ensure that happens in the future. But Statement number 87 is related to leases, and what are currently only on the books as capital leases. GASB 87 is expanding the leases that are put on the books, and that looks at long-term leases largely. And what is going to be focused on are some more of the town's operating leases. So for copiers and things such as those nature. And that's going to be brought on as a lease liability, but it also, what the GASB is doing is they're saying, hey, if we're going to make you put on all these lease liabilities, well, we're going to allow you to recognize some of these lease assets that may be in existence. So some of those lease assets may be if the town owns land that cell phone towers are on. That would be a leased asset that the town is the lessor of that property. Further, any solar farm plants, things of those nature would come on as lease assets to kind of offset those long-term lease liabilities that are coming into the frame as GASB 87 is shaped. That comes into play in FY 2022. So again, I know I kind of went quickly through there and through those 4 recommendations, but in a nutshell, that's what we're working with for our 4 management letter recommendations in fiscal year 2020. Do we have any questions on those?
No, I'm good.
Perfect.
Good.
Awesome. Well, I hope we wrapped up and gave you guys a good pulse and good view and picture of the town's financial health in fiscal year 2020 and give confidence into going into the meeting that I believe is taking place tomorrow. Is that correct?
That is correct.
Veronica, is that in person or Zoom?
It can be either. We will be in person in Town Hall. The Board of Selectmen will be, but there is a Zoom link. So it's entirely up to you how you attend.
What time is this item going to be on the?
We're on the agenda for 6:15.
Okay. All right. Thank you.
All right. You're welcome. All right. Well, thank you, Zach. Thank you, Ed. We appreciate it. And this Zoom is recorded. I just want to let you know that, and we may post it to YouTube after tomorrow night's meeting, just to clear up any questions others may have. Is there any problem with doing that?
None over here.
Okay, all right. That's all we needed to know then. Thank you so much.
Thank you.
Perfect. Thank you all.
Thanks, everybody.
All
Bye-bye.
right, bye-bye.